Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike Zlatnik, and today it is my pleasure and a privilege to welcome back my really good friend, Chris Miles. Hi, Chris.
Hey, Mike. Good to see you again.
Great to see you too. Thank you very much for coming back on the podcast.
Hey, always. It's always fun to be able to share with your listeners.
Thank you kindly. I love your background. I know people listening in the audio mode, but I could see what it says in the back. Live your life now, not tomorrow. That's a great motto or great way to think about life.
Well, it is. I mean, it's I recently did a podcast. I kind of had this big epiphany when I was at one of our mastermind groups the other week. And I realized that everybody talks about preparing for your financial future, right? That's always like, how do I prepare for my financial future? How do I have that legacy and that wealth and yada, 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 right? But the one thing I realize is we need to prepare for your financial present. Because if you can manipulate and create your financial present, where rather than waiting 30 or 40 years to see if your plan worked, what if you could have your plan working this year? Well, you don't have to worry as much about inflation because you know what inflation is like now, right? You can't always prepare or know what it's going to look like. But if you get your financial present in order, you get that in place to where you are financially independent within the next few years versus waiting decades. Well, now you can create a much better financial future anyways. So if you take care of the financial present, the future is going to take care of itself.
That's a great argument, great logic. Of course, you have to enjoy the journey today in order to be patient for tomorrow to come. And it makes total sense. I don't know how people can plan 30 years out. Like how do you plan 30 years out? The brick can fall tomorrow on your head and you could have a problem tomorrow, but you have to live in today.
So many variables.
Live your life today, not tomorrow. And of course,
right.
you want to plan a little bit, but like you're saying, you got to get your financial plan in order today and live today. So
all we have is now. So if you can figure out how to make now work better for your future, that's the main thing.
So how do you do that? Let's now talk about kind of financial planning, some of the things you do in your financial planning. Things have been running pretty well recently. Again, we are in rapidly changing times. Inflation is pretty heavy. Interest rates are picking up momentum. We obviously have geopolitical issues. We have war in Ukraine. We have potential recession coming up, which is kind of, we don't want to sing the recession song today. We're in a still period of rapid growth in inflation, but people are already beginning to chat about a possible inflation. So I'll let you have the floor, but what are your quick thoughts?
Yeah, I definitely think we're heading to a recession. Everything cycles. I mean, if you're around long enough, you know that there's everything ebb and flows. There's great times, there's boom times, and there's bust times. And we've gone so long without a bust that that in and of itself is a bubble. When you go way beyond what's expected for stock market booming. We've seen like just things going rampant, like you said, with inflation. It's definitely, it has to come back into balance. And so to hit a recession shouldn't be a scary thing. However, if you are banking and literally calculating, hoping that the stock market is going to keep returning like it has the last 13 years, you're going to be severely disappointed. You're going to find out just how bad a stock market can do and what it can create, or what kind of chaos it can create in your planning. And that's why I call what I do anti-financial advising, right? Because I'm not looking at doing the traditional mainstream. I call it the Mexican food of financial advice, because, you look at Mexican food, as yummy as it is. The truth is Mexican food is all the same ingredients. It's rice, beans, meat, lettuce, tomatoes, salsa, right? A burrito and a taco have the same ingredients. They're just packaged differently and given a different name. Financial advising is no different. It's all securities, mutual funds, and insurances. That's all they offer. There's zero anything else outside of that world. And that's the world I came from. I started in that world 20 years ago, and I can tell you, there's too high of risk and too low of returns to really ever guarantee any kind of financial success in that kind of planning, which is why I left in the mid 2000s. And that's why I go more on the alternative side, where we look at things like real estate investing. We look at things like commercial, like doing like syndication with commercial or apartments or self-storage or whatever it might be, or even land. We even have clients, now I even got a partnership with somebody who does land, like seller financing. And I have $100,000 making me $4,800 a month right now, and there's all kinds of things you could be doing. You could be getting a franchise. If you had some extra time, 5-10 hours plus a week, you could get a franchise that could generate 6 figures of cash flow for you each year of profit. There's lots of things you can do outside of that traditional mainstream financial advice that really is just there because they can sell you so much crap. and that's why it perpetuates. It hasn't worked, but it perpetuates because you have guys like the Merrill Lynches and the Fidelities and the Goldman Sachs that are constantly marketing, putting billions of dollars of marketing onto the financial news networks, telling you they are the path, they are the way. Listen to us, or just put your money with us and just set it and forget it. Hopefully someday it's going to work out for you. But like we said in the beginning, it's not about someday, it's about today. And so the difference is, like, when I see potential clients come through, every time we're talking, I had somebody recently where we looked at their situation. I said, well, okay, if you go based on traditional planning, you'll be lucky if you can hit your income goal, because most people have some sort of income goal, whether it be 10, 15, 20,000 a month or more. They had 25,000 a month as a goal. And I said, with financial planning, the traditional way, and living on 3% of your income or of the balance in your retirement plan, you're gonna have to save another 20 years, which would put them in their 70s. I said, or right now, with the current resources you have in your 50s, we can start generating about 115,000 a year from your money right now. And if we reinvest 115,000, that just bumps up to over 125,000 next year, and keeps bumping up to where we can hit your goal easily within 5 to 10 years. And that's just something that you just don't hear on the financial news networks, because there's no financial company that's paying them billions of dollars to keep advertising that. So that's the thing I get excited about. That's why, even Mike, I told my clients about one of your deals, a couple of your deals really, and got them super excited, and they were reaching out because they said, hey, this is good. This is something we can actually plan for, because we know what we'll get paid from day one. That's something you don't get with the financial markets. You don't get that kind of certainty when you're hoping and praying the stock market just happens to smile on you just the right way, especially by the time you hit retirement. This is something you can actually plan for today. If you can plan and create today, it makes it so much easier to plan for tomorrow too.
So, Chris, thank you kindly for the wisdom. Thank you for the referrals. We are just honored and humbled. And yeah, I agree with you 100%. Real estate and many of the deals we bring forward, and many other investors on our network bring forward, have higher predictability. This is one of the words that I like to describe real estate. Still no guarantees. There are risks and everything, but predictability is substantially higher than the stock market and the mutual funds and all the products that the Wall Street sells. And as you rightfully pointed out, Wall Street incentives are drastically different from alternative incentives. And as a result, they built their sales machine to push the product that they have. And the product that they have is primarily driven around the stocks and some level of funds around them. And heavily incentivized some insurance products or some other products that sales network can get paid for. And a lot of the stuff is just, I don't know how to put it, but it's designed to feed the Wall Street, not necessarily to serve the investors. But that aside, now let's jump into more of alternatives and what you do with your folks. So how do you build a well-diversified portfolio? And again, in today's world, when we potentially are thinking about possible recession, I think diversification matters even more, because you don't know what's going to correct and what's going to do just fine during a sort of recessionary environment. So how do you work with your clients to help them underwrite deals or learn how to underwrite deals and how to do proper diversification? Let's just cover this topic a little bit. Due diligence, and then diversification.
Yeah, I think the important thing to always remember, and you know this, is that every person is different. Every situation is different, even though from a financial number standpoint, a lot of our clients look very similar in some ways, but the person The people behind the numbers are very different. And so when you're looking at trying to figure out what investments to do, you should be doing investments that really align with your values, and or they actually align with what you want your time to look like. What I try to tell people to do is don't just chase the dollars, because if you're just chasing money for a paycheck, so to speak, what makes it any different than a job? If you're just going after the numbers, like there could be investments that if something goes wrong, you might just hate it. You might get mad and angry, versus those that you might feel more comfortable with. Even if some hiccup happens, you might be able to say, you know what, it's okay. I feel comfortable and confident being in this kind of investment. And that's different for everybody. For example, I get some clients that love having rental properties, and they feel safe and secure having rentals. Great. Let's make sure they have good cash flow. We don't try to hope for appreciation, right? I don't like people to live on hopium. We don't want them to be on that drug. We really want people to really have something that is, like you said, predictable. They can be more predictable in that sense and steady. And so that could be great. It could be long-term rentals, but just know that there's a risk there too, because even though that can give you some great certainty, you have 100% ownership. There's no middleman between you. You can have a property manager obviously helping you out, but the property manager could drop the ball. Things can happen where there's vacancies or they're not paying. I have that with a renter right now where they're trying to apply for getting some government assistance to help with the paying the rent. Those kind of things can create hiccups. There's could be maintenance issues. Those things aren't fun. Now, are the returns, can they be awesome? Yeah, they can be great, and I can get better returns there than most other investments that I do, but it's not going to be fully passive. Where I get other people that say, I'm overwhelmed, I can't deal with anything that's going to distract me. Okay, if that's the case, let's not look at rentals as much. Let's look more towards syndications or funds, things like that, where they can actually have money coming in, but they're hands off. And here's the warning. If they do that, and I do want them to be diversified to some level, I believe you can be overly diversified where it creates too much of a distraction. I do have one client right now who has about 50 different investments, as in 50. The tracking on it is horrible, and even worse for his wife, who's afraid that when he passes on, she'll have no way to be able to manage it all. I did tell him, I said, hey, trying to go for $25,000 or $50,000 positions in each little fund might not be serving you very well. But as that money does get paid back out from those deals, let's maybe instead do 100 or 200, 250,000 per deal, right? And find your favorite operators, the favorite people you like to work with. Because the thing I'll tell people is when it comes to investing in funds, like we see Tempo Fund here or any other kind of syndication, anything where there's somebody else doing the investing, what's most important is who is that person that's doing the investing? Who is their team? Do they invest in it themselves? Do they trust in it that they're willing to put their own money in it? And then I'd say 4 is, of course, when their feet are held to the fire, when things go wrong, what is their integrity like? That's why I love investing with people that invested during the last recession. If they kept paying their investors, heck, I even know some that got burned badly and lost money on deals. But if they learned and they were able to adjust their strategy to be able to say, hey, I learned where I went wrong. Now I can do it much better and wiser this time around. Great. I trust those people way more than somebody who just said, hey, 2018, I joined the wave, this real estate wave, and I'm going to invest your money because I've made money twice so far. I'm not going to trust those people nearly as much those with a track record that had a track record of trying to do everything possible to pay their investors and to do the right thing and to not really be overly optimistic. They expect the best, but they still really prepare for the worst. They want to make sure that worst case scenario, they can stress test their deals and know that they still can be profitable. They can still pay their investors back. And so, I guess that was probably about 4 or 5 key areas, but when it really comes to that, it's, I want to be diversified to some level, but most importantly is who am I investing with? I'd rather invest with few people that I know or have good integrity than try to spread out all of my investments to 20 different operators and hoping that something sticks and some might not.
So my comment on that is great minds think alike. So I think the same way, or very, very similarly to what you said. It's actually a lot of wisdom in your philosophy and sort of your feedback to your clients. Number one, Of course, we always think about who we invest with first. This is the number one requirement. You can't even look at the deal as a syndication or a fund, whatnot. You have to know, like, and trust whoever you're investing with. You have to get that level of comfort that they can solve problems, they communicate well, they have high integrity, they have ability, they have skills, they have, I don't want to call them recession-proof features, but they certainly prepared for a recession in not ideal times, right? And once you establish that, you can obviously underwrite which deals you want to invest in and what checks to write. That's a starting point. The other really important point you mentioned, and I love this because we solve a lot of these very similar problems. As a fund manager, we solve many problems individual investors have to solve. One of them is how much diversification is too much. So do you write 10 checks? Do you write 20 checks? Do you write 80 checks? Right? And when you do write 80 checks or 60 checks, you end up exactly with a problem. You have a massive portfolio to manage. The portfolio management becomes an aggravation. So one investment, it's one thing to manage, right? Every new investment, it's another thing to track the taxes, the statements, the updates. So you have to be pretty smart about it. You have to balance return on investment versus the return on effort. So you can't have too many investments because of exactly the problem that you hit. You have so much work managing the portfolio. It becomes an overhead expense. Either it's an expense somebody to manage it, or your time. Instead of enjoying your life today, you're managing a whole bunch of investments, at least on paper. So
you have another job.
Yeah, it's another job, and I would agree with you 100% on that. And when folks invest, they really have to think about what are they investing in. If you invest in a diversified vehicle, a diversified fund, you immediately can write one bigger check into one investment that spreads the risk among many others, right? That's a number one. Number two, you achieve instant diversification, and you still manage only one investment. From that perspective, it makes a big difference. On the other side, you may have sort of, if you think about this, how do people build a portfolio? At least in my philosophy, you could build it with a few building blocks. And what are these building blocks in alternative investments? And this is, by the way, this could be true with the Wall Street too, with stocks. But your number one building blocks are diversified funds, right? Alternative funds, diversified real estate funds. But they become the foundation because a single investment spreads the risk among many. Then block number two, just quickly covering, is kind of your single strategy funds. If you like storage or you like multifamily, you get diversification, but within a given vertical. Number three, you go into one-off deals. It's either syndication or turnkeys. But let's continue this whole discussion. Now we're jumping into turnkeys and syndications. There's one thing that's really impacting all real estate today, rising interest rates. So let me just shift this conversation into that discussion. So we've seen a lot of movement in the 10-year treasury, which impacts the mortgage rates on single family, multifamily. And also we've seen, obviously, Fed taking action and the 2-year treasury moving quite a bit. And as of last Friday, April 1st, we're recording this on April 4th, but on Friday, yield curve inverted. Technically, 10-year treasury yield was lower than a 2-year treasury yield, which signals your classic yield curve inversion. And there's another immediate follow-up thought is that typically after yield curve inverts, recession follows, not always, but typically 6 to 24 months from this point on. So what do you think about what's the impact of rising interest rates on all alternative investing, and especially the folks that you work with, and the likelihood of the likelihood of recession, and how fearful do you have to be of the recession?
Yeah, I'll address that last one first. Definitely, I think there's a recession coming, and it could easily be in the latter half of this year. I agree with you. It could be easily 6 months out. We could see that finally reverse. We saw it threaten to do it in 2020, but then with all that artificial printing of money and everything propping it up, creating more of a bubble of the dollar, really, right? That inflation bubble is something that is going to create some issues, and it already is. I mean, we already seen people have affordability issues. Even just on a micro scale, where I'm hearing more and more investors saying, yep, I'm hearing even renters in the middle class having a harder time trying to make their payments that could affect things with rents. And I'm not saying that's the majority, but we're starting to hear more of these cases, more and more. And this is after everything's reopened, right? We heard this, of course, in the beginning, 2020, but now we're starting to hear people again say, "Oof, things are a little bit tight. I don't know how I'm going to do this because my food costs has skyrocketed 10+% in the last year, and plus everything else, and utilities are going up, and everything is happening there." And so, coming back to that, I mean, now we have interest rates rising too, which have been great. And that's helped the real estate market just drive up the values hard and fast. But there's going to be a point where I don't think we'll see like a big decrease in real estate values overall. I think there'll be pockets of the country that will see that. But I think we'll probably see what will happen. Now we'll start to see those prices settle. So people that are banking on appreciation, those that are really trying to flip properties and they're getting lazy on how they're buying their deals because they're not buying them cheap. They're just saying, well, by the time I sell it, it's going to be worth more anyways. I can make money. It makes, that when you have that kind of sloppiness, it's like what Warren Buffett says. It's when the tide rolls back, you find out who's swimming naked. And I feel like the tide's going to roll back. And you're going to see who really is swimming naked, who's going to have the issues. I'll tell you, even from my own personal experience with rentals, right? Like we were just talking about this with a mortgage broker last week, where we were initially quoted, of course, a lower rate last November. November rates were great. I mean, for example, the typical investor, 30-year fixed mortgage would be about 3.75%. Well, we check again, and guess what? It's about 5.25% or more for that same property. Now, just 5 months later. 5 months later, now we're looking at, and then most of this happened just in the last month or two. So if you haven't done anything with interest rates the last couple months, you probably even realize that mortgage rates now have skyrocketed up past 5% for investment properties, and it's well into the 4s for your own house. This is why even with planning, I've been telling people, instead of just trying to get like a cash out refinance, we've been looking more like HELOCs. And people might say, yeah, but HELOC's going to go up too. I said, it is, but with that interest only payment, it would have to go up to like 7% on your HELOC to finally hit what you would currently be paying on that 30-year fixed. That buys you some time to at least create some profit and make some more money off your money in the meantime. And that's the same thing. If you have rentals right now and you're going to think about maybe 1035ing into another rental property, you might hold off for a bit just because rents haven't quite caught up to what's going on with the interest rates. I'll tell you, the cash flow on those same new construction deals we're looking at went from 13% cash on cash now down to like an 8.5% cash on cash, just because the interest rates alone. So it gets you to pause and reflect and wonder, okay, is this really good timing? Do we wait for rates to settle? That's one thing we're waiting to do, is we're not locking any rates right now. We're actually waiting it because I think it will pull back a little bit within reason, but you never know. I mean, things could keep going up, and that could ruin some cash flow plays that you have.
Yeah, let's continue exploring this idea on the cash flow front. So the rising short-term interest rates and obviously long-term are substantially impacting immediate cash flow. Like you said, if you had a property on the contract and you were planning to close even a month and a half ago, and now you're coming to a closing table and you didn't lock the rate, you are up for a bad surprise. And yeah, if you look at the 10-year Treasury and 2-year Treasury from March 1st until effectively April 1st, they moved a lot. The 2-year Treasury moved over 100 basis points and well above 100 basis points, over 1%, and the 10-year Treasury moved approximately 3/4 basis points. And the problem is, because of not just the move itself, but the speed of the move, how fast it happened, is unsettling lenders. So like you said, right now the lenders overcorrected and they bumped up all the rates because they don't know if they originate today, what are they going to sell the paper tomorrow? Because most of them need to originate and sell. And if they can't sell it tomorrow, they're going to have a problem. So they're overcorrecting with offering the interest rate substantially higher where they should be if they just basically follow a 2-year Treasury and the debt spread, as they call it, the delta between mortgage rates and the 10-year Treasury. But let's go into cash flow. So turnkeys and obviously other investments that are sensitive to the interest rate. In the short run, you can't raise rents fast enough, right? You have to basically compute based on what you're paying today, or if you have to refinance, what the interest rate is going to be at a refinance point, that your debt service is going to be substantially higher. And because these things trade on such a basically margin, even a little increase in the interest rate substantially impacts the cash flow. You can have that interest rate increase could have just cut the cash flow, like you said, by 30, 40%. So how do you still invest? You still feel comfortable investing, even though the rates have moved up? If they're going to continue to move up for the next investor, for the next buyer of the property, their cash on cash is even going to get worse. So why people are still thinking, hey, I still want to invest? Do you think the rents increases will offset the interest rates higher costs of debt?
Eventually. Yeah, I think usually see rents will adjust every 6 to 12 months, when it comes to something like this happening, where it could be like from inflation, whether it's something driving prices up, so that eventually gradually there's a lag effect where rent prices will tend to follow whatever is going on in your own life too. So if prices are going up, then the rent will follow upward. If interest rates go up and it gets more expensive, taxes go up, whatever changes, you're going to have to adjust it. All investors are going to have to adjust to make it affordable. Otherwise, it's not worth the deal. But it does take time. So you could look at it as more, if you're looking more of a longer term play, then you might not be worried at all. You might say, this is fine. It's going to balance out. That just means rent's going to have to go up again to a degree. I think this would be, I think the cautionary tale would be if you're looking at places, particular real estate properties where they maybe are attracting more of an upper middle class, upper class type of buyer where there's less buyers there. I think that would be risky, because whenever there's an affordability factor, which I see is that affordability bubble we're having, right? Where people are realizing the inflation is eating their cash away. If you're in that higher rent percentage for the area, you could be at high risk versus being on the lower, more affordable type of place. This is why, the buzz term of affordable housing and affordable apartment building is so important, because that's really what people are looking for is, hey, do I have to downsize? And in any recession, when they downsize, that you want to be the one that they downsize into your rental versus, someone who's had this perfect, beautiful rental. It looks great, but then there's hardly a market to buy it or to rent it. And now you're having to lower your rent prices to adjust it. So if you are looking to rent and you're looking for a long-term strategy, just know to keep it on the lower end. I'm not saying bottom feeder. Don't go for the Detroit inner city bullet hole ridden type places. I'm talking about more like you might be looking at places that are around the $100,000 to $200,000 range. Maybe not much more than 200,000 or so, or $250,000 depending on the area. But really keep it in a place where the rents are going to be right about average or just under, so that you've got plenty of a market that will compete for that price.
Yeah, I love it, Chris. It's the substitution effect as affordability gets worse due to the higher interest rates. Substitution effect takes folks from more expensive property to less expensive property, and those who can't really buy anymore because their affordability got hurt, maybe they'll rent instead. So demand for rental typically increases when you have worse affordability to buy. That's the first. And then the second thing is substitution to good quality but less expensive, more affordable type of a product. So it makes total sense. I'm completely in agreement that the affordable or workforce housing generally does well, excluding let's just call it the really rough product, the class D and C. I would say product has to stay with a B- or better type of a product, so that you can have a relatively easy to manage type of investment, and you want to stay away from the lower end of the spectrum. But we're on the same page there. So let's continue exploring a little bit, and we don't have a lot of time, but we'll keep chatting a little bit. So let's cover a couple of other interesting points that I know you are super specialist in. You do whole life insurance. This is part of what you offer, part of the infinite banking, which is a great concept. Love the concept. And how does that change, or what's new in that industry versus before with rising interest rates? Is this something that obviously folks can borrow against their policy? Anything new over there, and anything else is happening out there? And how's whole life how's ability to borrow against whole life different from borrowing against universal life? Just a very technical question, but would love to hear your thoughts.
Yeah, I mean, definitely with whole life, there's a lot of certainty. Just again, we like predictability, right? As any investor likes, we want predictability. We want to make sure we can control our returns. And whole life is definitely that way. Now you don't control the return of the whole life policy because the insurance company does that. But when you make at least a 3-4% minimum guarantee, and in most companies right now, even the lowest interest rate environment, although it's starting to shift now, even in a low interest rate environment, they've been paying between like 5.5% and 6% typically, which is really good considering that's tax-free money coming to you too. So there's no taxes. You only have to report it to your tax return. One thing I do love. Just from that standpoint, it's a good place to store and harbor cash, right? But we don't stop there because we look at this as not just a way to store and harbor cash and put it away long-term like most insurance people try to teach you to do, but instead this is money we can be able to utilize to invest. Now you could withdraw the money, but if you withdraw the money, you pull the money out, it doesn't make any interest inside the whole life anymore. You're just making money in that investment, which is what most people do with savings. Well, what we do instead is we can get a line of credit against the cash that's in there using the cash as collateral, get a line of credit against it, whether it be from the insurance company or certain specialized banks to take that money and use that to go and invest elsewhere. And here's what happens is because, I even had a client recently, he was a dentist that he went to his credit union, found out they would give him a line of credit at 3.75% against his cash. Now remember, he's making about a net 5% tax-free on this money already. He's borrowing at 3.75. He's making a 1.25% spread. And he's still taking that money and investing it to make money over here too. So if he would have normally just made 10% on that investment, well, guess what? Now you're making, 11.25 for doing nothing more than what you would normally done from a savings account. It's like free money for you. There's even banks right now. I got a line of credit set up with one. I actually just did a podcast with one of these banks. This one's called the Bank Corp. Or the Bank Corp, I guess it's like one word, BANCORP. But with them, I can get it as low as 3% right now. Now it floors at 3%. It is based on prime. So as the feds do raise rates, which they will do, it does raise that rate as well. But the nice thing is that the more I have in cash value, if you have at least in that case 68,000 with them, there's other banks that are like 50,000 minimum. But if you have at least that much in cash available, you can start getting these other bank loans at a much cheaper rate than the insurance companies, which are right around 5 or 6% right now for their loan rates. So I'm getting around 3%. And even as they raise rates, the more cash value I have, the better the rate they give me anyways. So I'm creating this 2% spread while investing that money elsewhere and doing a great job with it. Oh, and here's another point too with those raising rates. Even if the rates do rise on the loan side, remember that most of the time insurance companies, when they're paying you a dividend, they're investing in treasuries, bonds, things that are interest rate laden, right? So when rates go up, that's actually good for you because right around 2000, Y2K, even in the 90s, they were paying about 10% plus because rates were much higher back then. It's only been the last 10, 15 years because rates came down with the last recession that they've paid right around, 5 to 6%, depending on the company.
So if I hear you correctly, it is probable that the new policies issued with the insurance companies with rising interest rates will pay more return on the policies, on the whole life policies with high interest rate environment. Because the insurance companies are starved for yield when they can't find places to deploy the cash, they can't pay investors as much. So as interest rates rise, insurance companies generally can get a higher rate of return on that money. And as a result, they're able to pay investors. So if you haven't thought about getting a whole life policy, now is the time to reach out to Chris and to talk to him. It's a very powerful concept. We were just chatting before that universal life versus whole life. Universal life is tied to the stocks, and you can borrow as well against universal as you can borrow against whole life. In many ways, whole life is a better product to get that access to cash based on the cash value of your policy versus the universal life. Any other quick comments on that?
Yeah, it's funny because you listen from a banker's perspective, right? Bankers like to take low risk too. They are investors, and when they look at universal life, they see risk because even if you don't get if you get an index universal life where they don't go below 0%, still because of rising insurance costs, you could still lose money on the cash value side. So they won't lend against it. In fact, they have a hard time wanting to ever lend against those kind of policies. So when you have people talking about infinite banking, they're saying, yeah, but don't use whole life. It's boring. Use index universal life because look at the stock market the last 13 years. Well, I have. And this would be the worst time to get in the stock market right now, is to have something tied to a stock market right when it starts going down. And then you realize it's not performing the way you thought. And that's why I even stopped selling them in the mid 2000s, when I stopped selling universal life as much, for that very reason. So you got to be careful. Just because the brochure looks good doesn't mean the reality is going to match up to it.
Yeah, it makes sense. I totally agree with you. And the whole life, it's basically a pretty safe part of your portfolio. And that's something that is both life insurance and a saving mechanism and an access to liquidity. So it's so powerful. That's why they call it infinite banking, or part of your self-banking, by having a good whole life policy. So we're kind of running out of time, but any final thoughts, comments? How would folks reach out to you? If they will want to talk about, again, infinite banking, when they want to talk about getting some help diversifying their portfolio or getting into alternatives, because this is what you do. You're anti-Wall Street investor, and you're an expert in those things, and most investors could benefit by working with someone like you, or not someone like you, with you.
Yeah, it's true. Not to be egotistical, but yeah, we're awesome at what we do. And that's the point, is that we really do good with the planning side, and we do great with the infinite banking side to get that max ROI possible. So, I would say the final thoughts are just this, is that even with an impending recession coming, it's going to happen one way or the other. It's not a matter if, it's when, and it's overdue, and it's time to hit. Well, regardless of that, this is why you should be tuning into shows just like this, because we can't always predict which month it's going to happen, but as time goes on, clues come out. And when you have a good, strong team around you, when you have people that got their finger on the pulse, they know what's going on in the marketplace and that sort of thing, it gives you more confidence to be able to know, okay, I can prepare a little bit. And so this is not something to be afraid of. If anything, there's going to be opportunities coming no matter what time we're in. The question is, are you surrounded by the right people and the right voices, versus the gamblers out there? They're telling you to keep putting money in the stock market because that's what's hot right now, and you want to stay away from that stuff. So, you can do that. You can follow us. You can follow our company, Money Ripples. You can go to our website, moneyripples.com. And any questions you have, if you want to chat with us to see what kind of cash flow you can create, you can just go right on the Contact Us page. We even have a passive income calculator that can actually calculate for you pretty accurately, within a few $1,000s, how much money you can make in the next 12 months passively. So we've got that on the website there. And of course, we have our show, the podcast, the Chris Miles Money Show, that you can find on YouTube or iTunes or anywhere.
That's awesome, Chris. Appreciate your wisdom. Thank you for sharing. moneyripples.com. And let folks learn from your wisdom through your podcast, and just reach out and chat. And yeah, I happen to agree that one of the most dangerous things, by the way, for stock market is rising interest rates. Most people don't realize it, but rapid increase in interest rates is like salt on a wound of technology companies or heavily leveraged balance sheet companies, because the debt service on their payments on the debt that they owe goes up immediately. But revenues, is not that easy to be able to adjust revenues. Especially the companies that don't have big install base. To correct this joke, the McDonald's of the world, they're always going to do fine. Even if the interest rates go up, they just increase the price of the burger a little bit. And most people, they substitute from the expensive food to the McDonald's of the world as a kind of a substitution effect. People don't necessarily go out and buy a lot more junk, but they get obviously more sensitive to paying more even for basic staples and necessities. So interest rates is something that the stock market can actually take it on the chin, sooner rather than later, a lot faster than anything else. But it is what it is. It's had a great run, and recessions are good because they clear out, like you said, Warren Buffett's once the when the tide comes down, the people who are swimming naked will be visible, and that's what the recessions are for, is to clear out that type of market and those type of players. So thank you for your wisdom. Appreciate you coming on the podcast. Would love to have you back again. This was awesome. And folks, please reach out to Chris, moneyripples.com. Thank you, Chris.
Thanks.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to bigmikefund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.